Morning, Cameron.
Morning, Chris.
How are you? Yeah, good.
It's good. Leading into June. We're here to talk about last month's economic update.
Correct.
Market movements, economic update. And look, I think it's fair to say, mate, there's been a fair bit happening in markets over the course of the last 12 months or so.
Yep, I think that's fair to say.
Yeah. So we'll work through some of that today, and then and then hopefully give you guys a good overview as to where things are at. So firstly, if we just take a bit of a look at the GDP growth around the world.
Yep.
Of course, I actually really like this chart because it goes back through early 2000s about a bit of volatility that's been around.
Yep.
And if you have a bit of a look at, say, obviously 2020, when we had COVID, it was a very big negative number.
Yep.
Coming out of COVID was a really positive number all around the world, the G3 economies.
Correct.
It's fair to say now that it's stabilised.
Yeah, well, yeah. If you look at the what would be the range of that, we're back in the range. So,
yeah. Yep. And so if you go back through, I guess, 12, 18 months ago when we were doing these video updates,
Yep.
we were talking about, are we going to have a smooth landing, or is it going to have negative dips? But now it's actually it's a nice story to tell, isn't it?
It is, and I guess even considering, and your point here about long-term context is pretty important because, as with markets, it's always very short-term focused, and I think if you still had that short-term sense of focus, you might still be worried, I suppose. Well, I'm not saying there's nothing to worry about, but your frame of reference in terms of how you're feeling and your emotions and this decision making, but taking a step back and looking at it over that time frame is just to sort of say, well, we almost kind of got our soft landing in a way.
Yeah,
Yep.
Yeah, that's right. I agree. Just been excellent. Again, inflation around the world. We had massive issues with inflation. Some very big numbers there. We got up past 9%, which is pretty scary at the time.
Yep.
But then reserve banks around the world have done an excellent job of pulling that back. And again, we're now looking at more stable inflation around the world as well.
Yeah, correct. I think interestingly, if I was to look at the trend lines again there over that time frame, slightly above long-term trend lines, but I guess that's probably, which we've kind of been talking about for 18 months, is the last mile in terms of getting countries back to.
Yeah, that's right. And the story's not over yet, is it?
No.
So, but it is nice to see most of that sitting underneath that 3 number, because the ranges around the world that they're typically looking for is around about that 2.5.
Correct.
So 2 to 3.
Definitely better than 9.
Yeah, that's right. Importantly in the US, and I think we tend to be fairly US focused here in Australia because it does impact us. So I think also it's important that we go through what's happening with inflation in the US. And one of the key measures here is core inflation.
Yep.
And that was sitting at 2.57, which is perfect. I mean, it's not quite at the Fed target, which is down to 2, but sitting between that 2 to 3% range. And then last month we saw core inflation grew only by 0.1% over that period of time, which is
well, if you extrapolate that over 12 months, then we've got a bit of a problem. But
1.2.
Yeah.
Did you like the math?
Yeah. It's again, in the context of the last 18 months or even longer than that, sort of maybe even really the last sort of 5 years, I guess, post COVID. It's nice to kind of be back where the federal banks or the reserve banks, sorry, not the federal banks, want us to be within QE, I suppose.
Exactly. Let's talk through Australia now. So we'll bring it back home. GDP growth in Australia. So again, what we're looking at here is a large disparity through COVID, which we know about. But importantly, what we've seen in the last set of GDP growth numbers to the end of last quarter, which is actually March quarter, is we saw a really nice set of numbers that came through there as well. So GDP growth, that's actually GDP growth numbers are coming out today. Later on this morning, we're doing this pretty early, and so it'd be really interesting to see what numbers that hits. But it's expectation is that it's going to continue on that small upward trajectory that we've seen.
Yeah, correct. I think some growth is good, really. But Yeah, I just the thing that keeps flashing to me, and I don't want to bore everyone with it, but is coming back to that kind of long term trend, is that we're somewhere close to where we want to be. From a financial stability standpoint.
Right. CPI inflation in Australia. I mean, this is just a familiar story now. I feel like I'm repeating myself, but the inflation numbers in Australia are actually pretty good as well. So we're sitting underneath the 3% band, and there'll be more numbers come out shortly, but it's fairly consistent with what's been going on around the world. So I think we're just going to make a comment now. One of the things that I've been talking to my clients about, or my clients have been asking me questions about, has been, we're doing reviews and we're doing updates, and they're saying, oh, how are things going? Things must be really challenging for you right now. And I think, and that's because, the reason they're saying that is because when you turn your TV at night, you see Owen Collar, or when you whatever is pushed out into the papers is only the negative news. And this is why it's important, Chris, I think, that we do these updates, because the economic story is actually pretty good.
Yep.
Like we're not in a recession. Inflation is not, booming. Things are actually pretty good. We're in a pretty good spot.
Doesn't sell newspapers or
no, I know, it's pretty boring, isn't it? Right.
Yep.
That's what I keep saying. We're going through this and going, well, everything's okay. Like the numbers are where they should be. It's actually kind of makes things pretty boring for our listeners.
Well, it does. But it's that contextual piece, really, then, isn't it? Like, economies are slow-moving beasts. Like, it's turning a boat around like a giant sea liner around, effectively. So they're the things that I guess people need to focus on and be making their financial decisions through that lens.
Yeah, that's
not getting distracted by the shorter term piece.
Noise. Yeah. Households in Australia. So the one thing I wanted to point out here was, the two things I wanted to point out here was consumer sentiment. So of course, consumer sentiment fell off a cliff when interest rates ratcheted up as quickly as they did.
Yep.
And the price of things also ratcheted up through inflation. So we saw that occur, but it's starting to turn around, and it's been turning around for probably the best part of the last 8 or 9 months.
Yep.
So we're starting to get some decent numbers. It's not back up in the hundreds where we kind of want to see it. Yep. But also the thing that's sort of potentially driving some of that was that the savings ratio went from, during COVID, no one could actually spend any money.
Yeah, correct.
Was up to 20%.
Yep.
It dropped down almost to zero. And that also includes superannuation contributions too, at 10% on. So subsequently, with the savings ratio now, it's starting to peak back up a little bit. People are feeling a bit more confident, and I think disposable incomes are starting to rise as well.
Well, I think that just means looking forward, just more stability, really, isn't it? It's like I was really pleased. We sort of haven't revisited these numbers for a little while, as we were remarking before this started. Yeah. And I was quite pleased to sort of see that consumer sentiment kind of come up and the disposable income number above zero, because it just sort of says that we're in a bit better shape.
Yeah, that's right.
People have got a bit more certainty, which is obviously going to make you feel better, so your sentiment is going to be more positive.
Exactly. Policy interest rates around the world. So as we all know, interest rates have started to drop. So inflation's under control.
Yep.
Interest rates have started to drop. Anecdotally, it looks like there'll be potentially between 50 basis points and 75 basis points drop here in Australia during the course of the year.
Yep.
Of course, that's a prediction. We don't actually know if it's going to happen, but that's what markets are currently pricing in. Correct. So that'll be nice for all of us that have got mortgages. I think, and importantly, reserve banks can start reducing interest rates because we have such great numbers around GDP growth and inflation.
Yep.
So,
yep.
We haven't talked about the US president yet.
We haven't, which is nice, actually. I think people have kind of had enough of it.
Yeah.
I was just on that. I was just thinking about this before we walked in, and I was like, I wonder if anyone, because was going to mention, have you heard the TACO acronym during this week? Trump always chickens out.
No, I have
And I was like, I wonder if he was going to bring that up in the
you just
monthly
did.
update. And I was like, it's just interesting in terms of it's almost turned from fear and uncertainty to a sense of parity in a way. So
Well, there is some parity about a Trump presidency anyway.
Yep.
Let's be honest.
Yep.
So, from the context of where the US is at, and obviously they're introducing tariffs and that sort of thing, depending upon the level of tariff and depending upon which countries it's applied upon and all those sorts of things, Willis Towers Watson, our investment partner, has, I guess, done some forward projections around US economic growth, as well as US inflation. Now, with the US, with the proposed tariffs as they are at the moment, what they're expecting is that there'll be an increase in CPI in the US over the next 12 months by around about 1 percentage point, 1.0. Which is not insignificant because they're coming from
significant,
2.6. That gets them into the 3.5, 3.6 range, with a lower level of economic growth as well. So obviously they've had one negative quarter of economic growth. The projections for this quarter, second quarter, is still positive. So that wouldn't class as a recession, would it? But if it was a recession, it's the I guess W2W perspective, you said it's going to be shallow, going to be short lasting, and that's evidenced through this chart here. That sort of does show that we see our way out of that. And importantly, if the tariff rates, if it's 10% or 15%, whatever the number's going to end up being, for most economies, those tariff rates, that's an increase. It's almost like a once-off increase in inflation. Because we see CPI rise, and then because there would hopefully be no additional tariffs on top of that, that will then maintain.
So it sort of gives the Fed a bit of an issue for a period of time, I suppose. That lower economic growth is it'll be interesting because I think as we're about to sort of flip into the next slides, it sort of then I guess it brings up some question about allocation amongst geographies.
That's right. Let's have a quick chat now about portfolio performance. We're just using the Lifestyle Model 4 balanced portfolio here, which has a 70% allocation to growth assets, 30% allocation to defensive assets such as bonds and cash and fixed interest. And again, this goes back to that commentary we're often having with clients around, they're concerned and worried and know that and will feel like markets have fallen. Now, markets did fall. They did fall, obviously, which we've talked about in previous updates. But they've also, since that fall, recovered quite significantly. So in this chart here, you can see some of that fall in here, but then you can see the full recovery as well that's occurred. So, looking at the 1 year numbers to the end of May, out of this portfolio, being that balanced portfolio, it's 11.88%, close to 12%, which is actually, it's a pretty stellar year. That's well above what we're trying to get for that portfolio, isn't it?
Correct. It's just interesting. As you were talking, thinking about there's just the classical behavioural biases that investors exhibit. I guess you're worried about what's happened recently in the past without any, I guess, sort of letting that affect the decisions that you make kind of into the future. I know obviously we've talked to clients about our portfolio philosophy. It always seems to be the way, really. So climbing that wall of worry tends to happen over and over again. And I guess the importance of being able to be coached through those behavioural biases, because I know lots of my clients would have probably preferred to exit right at the wrong time.
Well, it's scary, and it feels, that's how it feels. It feels scary. It feels like, and when people are scared, they want to do something. So some people want to do something, some people freeze. So I think, and we can even go back to this chart here that talks about what happened during COVID. Now, if we go back to March 2020, that's when the market went. But that, the market dropped
15% in 3 weeks.
20%.
Might have been more.
in 3 weeks. And so, that was because, everyone's wondering, the supply chain's disrupted, and what's
no one could price a thing. So
no,
it was like,
that's right. Yep. So these exogenous events, these events that no one expects, always occur in markets, and it makes you feel scared. But when you extrapolate out the time frame, this, I'm going to almost say it's just like a small blip in the time frame of the portfolio, right?
It's just again comes back to the frame you look at it, right? So if we looked at this over a 30-year time frame, it would be a blip. Yeah, the further you get away from it, the smaller that blip is. Like it's just, just find it. Again, it's just the behavioural aspect is really fascinating.
Equity market performance. So what we have here is the ASX 200, which is IOZ. We have the Vanguard US Total Market Shares Index ETF, which is VTS. That's the US market. We have IWLD, which is the world market unhedged. So looking at the numbers over the course of the last month, that's a good set of numbers. 7 and a bit, 6 and 4.
Amazing.
If you look at it over a year, that's a very good set of numbers. There's some 16s in there. Yeah. And then the Aussie market at 13, you look at it, so again, just expanding the time frame out.
Correct.
If you look at it over the course of, say, 7 years, you're looking at 13s, 14s and 9s. So there's some good numbers there, there's some good returns if you're prepared to stay in the market.
Yeah, correct. As we were looking at this earlier, I just really remarked to me that because I've had a lot of conversations recently with clients who are saying, okay, I'm happy to invest, but I don't want to invest in the US. Yeah. Because I guess I'm a bit concerned about what's going on. Yeah. Whereas those conversations 18 months ago were flipped. It was like, well, I want to invest in the US. I don't want to invest anywhere else. And I've just found it really interesting that over 7 years, so that's, I guess, typically a full economic cycle, you could throw a blanket over the IWLD, which is all the world outside of Australia, yeah, correct, and then VTS, which is just the US share market. Very close.
Very similar, aren't they?
So, we're always looking at this for clients in a long-term context, and diversification's the outcome there that shows you that you try not to take bets on what's going on in a shorter-term context, because your outcomes.
That's right. So this chart here is about market timing. We've shown it a number of times. I really like it. I still use it with clients on a regular basis. It essentially talks about how long and slow probably the bull markets are, and how short and fast the bear markets are. The biggest one being around about the 87 stock market crash, which was down 43%. But then also back in the GFC times, minus 48, which was down over 1.3 years, so 15 months. And then also COVID that we saw minus 27, but you've got to be prepared to do the weighting.
Yeah, exactly. Comes back to those emotional behavioural biases.
It does. Which then goes to this slide, doesn't it? So, 10 of the 20 best trading days occurred in years with negative total returns. 11 of the 20 worst trading days occurred in years with positive total returns. So, staying the course is most important.
I get reminded of this every time there's one of those days where it's all over the news, and then lo and behold, no news in the subsequent days, and then you look at the what's happened. Even just the tariff stuff that happened recently, 1st of April. Yeah. That was bedlam. And then, there was a week or so in there where no one said anything, and we recovered most of it. It's just
9.5% up in a day.
Yeah, it's just
once he reneged on his tariffs. So
you missed out on that. Yeah. It's like, well, what were we looking at before? 11% returns in a year? Like that's
that's right.
by making an emotionally based decision, you've lost a year's worth of return.
The disclaimer, Chris, obviously there's only general information. It doesn't take into account any personal objectives, financial situation or needs. So, thanks, mate. Been good to catch up.
It's been good. It's nice to go through those numbers again. It's been a while. So.
It has. All right, thanks everyone.
Thank you.
We'll see you next month.
See you soon.